Hello, everybody. Kirk Spano, investing 2020s and everywhere else that I am. Going to take a very quick look at the mid-year outlook. Not much, but I was going to give it a quick review before we jump into our plug-and-play stocks and talk about selling some cash-secured puts and even some covered calls, which is rare that we sell covered calls, but I think this market might be giving you that opportunity right now. So in the first half of the year, we saw large cap tech, the mega caps in particular, the Magnificent Seven, as they have started to call them. Where did you hear that first? The guy was calling the top stocks the Magnificent Seven, 2 years ago, 3 years ago? So I think that's sort of interesting. One of the stocks is new. One of them got replaced. But now you pretty much know who they are. It's Amazon, Apple, Meta is back. Who else? Amazon, Apple, Meta, Alphabet, Nvidia, Tesla, and who am I missing? I don't know. Some other big company. In any case, the mega caps have led the stock market up, and it makes people think that we're having a great year in the stock market, that it's all just peaches and cherries and chocolate and cream and strawberries and whatever else it is you like, pizza. And that's not really the case. The equal weight index for the S&P 500 has trailed substantially, mainly because if you're not in the top 20 or 30 stocks in the S&P 500, your portfolio isn't up. Yes, I missed Microsoft a moment ago. That's usually the one I miss, mainly because it's the most boring of the group, but probably the most solid financially. Who wants a boring, profitable, cash-rich company that just keeps making money? In any case, managers this morning on Bloomberg were talking about reallocating down the capitalization chain, investing in smaller companies. You've heard that somewhere before too. And I think that we want to get into our small and mid-cap positions this quarter, probably to the fullest position sizing that's appropriate for each of us, because it is clear that the Magnificent Seven and quite a few others, Salesforce, have undergone such big rallies that it's going to be very difficult for them to keep on pushing those stock prices higher. The price to earnings ratio suggests that rather than looking 1 year ahead on valuation, they're priced as if the profits in 5 years are going to happen next year. Probably unlikely. So I think we probably see a S&P 500 correction of 10 to 20%. I don't think it'll be bigger than that unless there is a regional banking crisis, the repo market falls apart on quantitative tightening, an international event, aliens, or some other thing that we're not prepared for happens. And interestingly, most of the bad things out there that we can think of have been thought of, somewhat planned for. Regional banking crisis, I just don't think it happens. I think that there's still some work to be done in the regional banks, and I think that credit will tighten up a bit, but I think it's unlikely that we see a collapse. The repo market that collapsed in 2019 and resulted in a stealth quantitative easing. The Federal Reserve has a plan for that. They still have about $700 or $800 billion of that $1 trillion fund that I've been talking about for 3 years that is still in the market. And until they suck 700 or 800 billion out, you probably don't see a lot of cracks, maybe a little less. Internationally, unless Russia drops a nuke or blows up a nuclear power plant, I just don't see anything out there short of some wild card nuclear thing, which could happen anytime, happening. It hasn't happened in a while, since the 1940s. Let's hope it doesn't happen again. If there's a revolution in Russia, I think that that's bad for a day or two. And then I think the world says, yay, unless they go hard right and expand their wars. NATO seems to be on the verge of including more countries. I think Russia is probably spent to the point that they really can't do much of anything else anymore anyway. They can't even pay their mercenaries. So for the life of me, unless the aliens land and they're not nice, I can't find a black swan. But then again, that's the nature of the black swan. Hard to find them. I think the stock market and the economy are both okay at this point, with the exception of the mega caps, which are overvalued. But because people pour money into index funds, will they ever crash outright? Or do they just present buy the dip opportunities every so often. The Federal Reserve is on pace to shrink their balance sheet $1 trillion this year. I think they'll roughly get there. But I think by the end of the year, they're at least talking about ending quantitative tightening or winding it down or reducing it. Chairman Powell gave a hint of that just the other day. He might talk about it in July at their meeting, their press conference. My guess is he holds off to talk about winding down quantitative tightening for a couple more meetings, because I think he would like to see the stock market get just one more bloody nose. And if we get another bloody nose, we should probably buy it. Let's kind of go through a handful of things here now that we got the images. Talked about some of the stocks we've been buying. And I want to talk about treasury bonds. I think that the 20-year treasury is probably done or almost done going up in interest rates. TLT, the treasury bond ETF, is probably about done going down. They move in inverse directions. Everybody see how the alligator jaws here and here came back together, snapped shut. Something that we talk about from time to time. Alligator jaws usually close. So here we have 20-year treasury rate a little over 4%, which is roughly normal historically, which is why I have introduced the phrase, the great normalization. They're calling it they're calling it something else on Bloomberg. They're calling it the great moderation, and that's just a dumb way of saying it. That's one of the few dumb things that I hear on Bloomberg. Almost everything is pretty smart. It's the great normalization. It is the return of interest rates to normalish. They did it in under 2 years, which is why all sorts of bank CFOs are crying, oh, the Fed did it so fast. Well, they told you they were going to do it fast, but you chose not to listen for ideology or lack of professionalism or lack of economic understanding, whatever the case might have been. You didn't listen. So now here we are with interest rates almost near historical norms. Probably could go up another half point or so, maybe even a point. But I don't think it will happen. And here's why. Very simply put, the industrialized world and even the emerging markets, really any country with debt, which is 90% of the countries, really only the exporting countries of OPEC, China, and a few others don't have debt. And even China, because of all their internal debt, isn't in all that great shape. So I think that interest rates will start coming down sometime in the second half of this year, but could be as soon as the Fed meeting if Powell is dovish. I've tried to get him to take my call. You know that he doesn't. We had a bad fight in college, I guess. I think Powell should be hawkish at the meeting coming up, just to give the market the jitters and the ability to have some price discovery, so that the great divergence, the separation of good stocks from bad stocks when pricing comes into play, that is dissipated due to indexing over the last 15, 20 years, can come back. There are so many stocks because of SPY and VU that are much higher in price than they should be because they're among the largest companies. So the largest companies have really gotten too high on valuation given their growth rates and even their financial strength in many, many cases. So one of the places that I'm going to start looking to short, or at least I'll write articles telling people to sell stocks if they own them, are going to be those 200 biggest stocks that are out there. When we go to the very short list, I have a page for Dow Jones Industrial Average and mega cap stocks. If you go through this list, somewhere in the range of 20 to 30% of these should be trading at single-digit PEs, and yet they're not. Why do I say that? It's because a price to earnings ratio should be reflective of the growth rate and the financial stability of the company. Should be a number between 1 and 2. Close to 1 is usually optimal, but if a company is very strong financially, it can be closer to 2. Price to earnings divided by the growth rate. So if the growth rate is 10% and the company is marginal in its financial strength, you would want a PE close to 10. So that PE to G is close to 1. Now, a company like Apple or Microsoft, because they are financial fortresses, you can have a PEG ratio, which is the ratio that Peter Lynch used the most, close to 2. For small cap stocks that are very growthy, it's a little harder to use these ratios, but anything under 2 is usually good, in particular, if you know that the company is not going to zero. So the companies that we own, we actually culled the list by 1 this week. We took a company called Satellogic off of our list because they're just not executing, and it is clear that they're going to have to dilute. The company is a takeover target, but I think the stock might have to drop 75% or so from here. One of our other stocks, also a satellite stock, not an imagery company though, Satellogic, Planet, Black Sky, they're all imagery companies. They take pictures from the sky. Spire Global collects radio data, different type of company in the satellite space. They too are likely to be involved in a merger or takeover at some point. I could actually see them acquiring Satellogic on a one-for-one basis. And I think Spire is the better company. But boy, if they could merge the imagery with the radio signals and the radio data, they could be the only company in the satellite space giving customers everything. Interesting, Satellogic has a bit of a relationship with Palantir, but I don't think it's going to develop into much. I'm not really sure what Satellogic has to offer to other imagery companies. Their satellites are smaller, but they wear out in under 5 years, which would not have been a problem if their sales were much higher, but they're not. Everybody has gravitated towards Planet and Black Sky among the small caps, then Maxar, which was acquired by a private equity company a while back. So when you take a look at that space, the satellite stocks in space, you're starting to see that market play out. So when we flip over to our plug and play stocks, that's why we focus on what we focus on, is we track how well they're executing. And we knew from day one, I even told you on day one of the companies would fail and probably one would get acquired, or there'd be some mergers and acquisition. The company that's failing, Satellogic, probably does get acquired. So going all the way back to the treasury bond, one of the reasons I've trimmed some of our dividend stocks is because treasuries are likely to come down to 3% again in the next few years, because governments of the world and the US government just can't afford real interest rates above zero. So the inflation rate and the interest rate need to be about the same. Otherwise, the government can't handle the added payments. And realistically, the economy is pretty good. I think Goldilocks would like it. We are at full employment. American businesses and supply chains are reshoring to give us more resiliency against international impacts. Janet Yellen used the word diversify versus decouple when talking about China recently, which is not only the right language, but it's probably the right way to go about things. Our reliance on OPEC is at a multi-decade low. Energy prices have fallen. COVID-driven inflation is falling dramatically, and standards of living have increased in general across the board. At some point, food production has to get a little cheaper, and we have a plan for that. In fact, I added a new company. If anybody's made it through the list already, I added a new fertilizer company to our list. It's a company we've been in before. Very nutritious company. Back to the economy, we can see employment has been pretty darn good, and now it's flattening out, which is what the Fed wanted. And remember, we've talked about the Fed. If they kill employment, they kill everything. So they need a slowdown, but if all of a sudden unemployment jumps a point or two, that probably breaks the whole thing. That's why I think the Fed is almost done raising interest rates, even though they're trying to tell everybody they're going to raise them more. I think they're just trying to talk the stock market down and bide some time. If Powell really puts his foot down and raises interest rates and doesn't start cutting QT around New Year, well, then he's really fucking up. I don't think that's going to happen. People talk about wages being sticky. That's good. If everything else comes down in price and wages are still sticky, everybody lives a better life. And that's what's been happening. So if everything gets cheaper or stops going up in price, but wages are good, that's good. What we have seen is one of the best recoveries in history. Granted, it was off of a very low spot, and now we're starting to settle, depending on the type of employee you are, but wage inflation of around 4%. So if real inflation is 3% and wages are going up at 4% per year, everybody's going a point in the right direction every year. That's wonderful. Now, it means that some of the big companies are going to suffer from a little bit tighter margins. I think that's going to be part of the reason that 20 or 30% of the mega cap stocks, 50, 60, 70 companies, because there's about 200 of them, over 150 billion, are going to get beat up. Certainly don't want to own them. They might be hard short. But once they start to shrink, once those charts turn over, at some point they plunge. Could be some pretty interesting catalyst trades around earnings and announcements for 50 or 60 or 70 of those companies being on the short side. So the Fed has raised interest rates back up to almost normal. This 4 to 6 range is where rates have been the most, a little bit higher during inflation in the 70s, and they spiked to kill that inflation and then came down for 40 years. I guess we could see interest rates get all the way to 8. I don't know how we'd afford it. So I think that we're going to start chopping along here and probably drift back down into the 3 zone. There's kind of a line that's formed in here. And about 3%, given what inflation expectations will probably be, probably works out. And nobody's talking about it yet except me that I can find. We probably do have a balanced budget in the 2030s. All the numbers point that way. All we need is a little bit of deflation in healthcare and energy. I think both things will happen. GDP has been a little bit low. Could this have been the recession already? Could we have already had the recession? I don't think so. I think we get a couple more marginally down quarters, maybe Q4 and Q1. Q1 is a typical one that's usually short. See it here and here. Even here, it was third lowest on the year. So if Q4 and Q1 are negative, or maybe just Q1 will be negative, I think that's probably it. Again, unless Powell goofs up. Jeremy Grantham talks about bubbles, and at the end of 2021, I was all on board with that. But I think a lot of the bubbles have deflated, at least partially. And we know that the central banks won't stay tight for too long unless they really goof up. Smartly, they were talking about deflation on Bloomberg this morning. They had a guest. I forget who he was a manager for. And as I've told you, deflation is still the boogeyman. So while we are in a transition period on energy and healthcare is starting to incorporate AI to lower costs, still have a little bit of inflation, but really deflation is coming back. And if you are an individual, deflation can be a good thing because your wages are usually stickier and corporate margins are the things that take a little bit of a nick. Given how rich our companies have become on high margins for no apparent reason, tighter margins won't be bad for anybody but probably the corporate executives who won't be able to participate in the big skim to the extent that they have been for the last 40 years. The offset to tighter margins is companies that have high growth rates and falling CapEx, small cap companies. So we've talked about two things that point to the direction of small and mid caps. Not only are managers starting to rotate, but the margin story is starting to point at small and mid caps and higher growth companies again. So while some people want to say that value investing is going to come back, I would argue that the definition is much different than you think. Buffett invests in a lot of growth companies, but he buys them when he can get them cheap. That's what I've been looking to do, is buy growth companies when I can get them cheap, when they're out of favor, when people don't understand them yet. They don't know how to assign value, that they're looking backwards rather than forwards. They can't even look forwards 90 or 180 days. Days, not years, days. So again, I think you gotta be careful with the large caps. You have to look for opportunity in small and mid caps. And if the dollar gets a little weaker because of the new BRICS currency and because of Bitcoin and because of U.S. interest rates falling a bit, that means emerging markets will do very well too. So we can make money in treasuries and emerging markets and small and mid caps, which are all the normal leaders when U.S. interest rates come down. Why would we expect it to be any different this time? And I think there'll be an amplification effect because the large caps, as people pull money out of them, will want to reposition it somewhere else. So I think small is where it's at. I think somebody is posting here about people taking money out of their 401ks to keep up with spending. I am selling 401k plans again. So what I'm seeing and what I'm reading on Fidelity, because they do pretty thorough studies, is that the balances in 401k plans have done nothing but go up. People have taken some money out lately, but it hasn't caused the balances on aggregate to go down. Was it 35 or 36 trillion in retirement plans right now? People might be skimming off the top to pay a credit card. I've only had one client do that. Again, I only have like 50 clients anymore. Used to have, 3-4 times that number. Just focusing on people who read my work. I won't take clients that don't read my work anymore. So when we take a look at what's really going on, I don't really think there's many big bubbles left. The mega cap techs are super high quality. Can they correct 20 or 30%? For sure. Will they? Don't know. I think 10 to 20%. is very likely. And then I think those 50, 60, 70 other large caps that are going to suffer from tightening margins and lack of growth and debt that comes due over the next several years are going to have a hard time. But I think growthy small and mid caps, industrial companies that use AI very well to manage their costs, real estate investments that benefit from reshoring and alternative energy, they're all going to do well. So there's lots of things that'll do well, even if the S&P 500 starts chopping around for a couple of years and doesn't have another huge run until 50, 60, 70 companies are replaced. I don't know that that's a scenario that I see, but it's one of the two that I'm thinking are most likely. When we take a look at valuations on the S&P 500, I told you to sell a lot of stuff at the end of 2021. And now we've been selectively buying for the better part of a year in the small and mid caps. And Bitcoin last November and December just backed into a Metis. That's up 500% since the day that I said back up the truck. There are metrics out there that we can follow, that I've been following, to give us the opportunity to buy things low. And that's what we'll stick with. Somebody asked about IETC, which is a more diversified version of QQQ, a little bit more equally weighted, but not much. I think that any fund that is super heavy in the mega caps, those 200 biggest stocks, but in particular the top, 10 or 12 or 15, you got to be careful with. I think that's a 10 or 20% correction waiting to happen. And owning the individual stocks, those 50, 60, 70 that probably have big trouble in the next 5, 10 years, you just can't own them. So I'll give you some short ideas. Over at Margin of Safety, I'll just say don't own this. And over at Fundamental Trends in the Rare Group, we'll talk about shorting something from time to time. I do not own QQQ at the moment, and I have a very small position in IETC. Oh, yeah, I forgot to add something to the plug and play. Caught me. All right. Somebody made a comment and I forgot to put it in the box. Okay, well, we will update that. So earnings are supposed to be up a little bit in the third quarter, but they're supposed to be up a lot in the fourth quarter. And this is where expectations for the current stock market valuations come from. We may very well hit small earnings growth in the third quarter, but the idea that we're going to have 8% earnings growth in the fourth quarter, I think that's going to get dialed back during earnings season in the next few weeks, and that'll cause the pullback in stocks, because there's no way, I can't see any way that this projection here of 8.2% earnings growth in the fourth quarter holds. This chart over at Yardeni, I think, is a good one. The PE ratio is almost 20. The forward PE ratio is almost 20 on the S&P 500, and that's with big growth numbers, expanding earnings. I don't think the earnings are going to expand as much as projected. Then down here in the mid cap and the small cap, you have PE ratios of like 14 and 13. But the growth is much higher here. At some point, price discovery takes hold, at least partially. Small caps become mid caps. Some mid caps become large caps. Some large caps are going to shrink. That is the great divergence. It should mark the rest of this decade. Peter Lynch, big companies have small moves, small companies have big moves, except when big companies have big moves down. So I talked about the different scenarios. I think we get a 10 to 20% correction soon, maybe worse if there's outside influences or a crisis of some sort. But the market could continue to rally through year end. And then it'll go through a choppy consolidation phase that could be, all the way back into the 3000s again. So the shape of what the market does can be impacted by sentiment, timelines, the Fed, all sorts of things. But when you look out 2 or 3 years, no matter what shape the curves are, you probably end up in about the same place. And that's why in the short term, you just react to whatever does actually happen. And you hold the amount of cash that lets you sleep at night. I started ticking up my cash here recently. Sold some stocks, including some dividend stocks, because I could probably do better in the treasuries that we're buying as interest rates come down, and I don't have to take single stock risk. I get essentially a risk-free asset. Granted, as a fund, they're not quite risk-free if you have to be forced to sell, but generally you get your money back. So the game plan is pretty simple. The 3 big secular trends to be aware of are aging demographics, decarbonization, and the fourth industrial revolution led by AI. Teladoc, the new stock that we're buying, that I need to add to the plug and play because I forgot, talked about it for 2, 3, 4 weeks now, is a company that probably helps with the deflation goal for healthcare. And since they're cheap versus United Healthcare, which is expensive, and United Healthcare has a conflict of interest in bringing about healthcare deflation. United Healthcare for years, their model was make healthcare a bigger part of the global economy and the US economy in particular. They have all the data needed to help with lowering the cost of healthcare, but that's bad for them. Teladoc, on the other hand, they don't have that insurance component and they're dirt cheap as it is. They just want contracts. So to the extent that they can help with healthcare deflation, they will. No conflict of interest there. Decarbonization, we've talked about that a lot. Fourth Industrial Revolution, AI, we've talked about that a lot. Industries, companies specifically that use AI well are going to be the leaders. So I think you ought to be very much considering, given the way the interest rates and the Fed balance sheet are going to move soon, and then a lot of large caps and mega caps in particular are overvalued, that the big opportunities are in small and mid caps still, and will be for years. Small caps have become mid caps, and mid caps have become S&P 500 companies is what we're looking for. Emerging markets, when interest rates seem to be going down, take profits if they are about to go back up. I still like Bitcoin. I think Bitcoin's going to 100,000 or more in the next 3, 4, 5 years. I don't see the BRICS currency being that big of a deal, but it is something that puts a little bit of pressure on the dollar. And that's fine. It's good for our exports if the dollar's not super strong. We just want it strong enough so that our standards of living are good. Over here at the Plug and Play stocks, I outlined everything for you. I'm not going to show the list, but there are certain stocks that are just too expensive right now. And in the large cap space, I keep them on the list because they're that good. I sold AT&T and Kinder Morgan in most accounts. Again, not because they're bad companies. And in fact, they're not even expensive. But if I could put money in treasuries and make the same amount, why wouldn't I do that? As interest rates come down, it's duration times change in interest rate pretty much can project what you're going to make. So if interest rates come down 1% in the next 2 years on 20-year bonds, you're going to make about 20%. Can you say that about Kinder Morgan and AT&T? I don't know. If those two get cheap enough and there's no damage to their dividend, there's rumors that AT&T might cut again. I don't think so. They certainly haven't increased the dividend since they divested Warner Discovery or Warner Brothers. It's been 27.75 cents for 6 quarters now. I'm not so sure that changes for years. I think that they will buy back shares first. And that's not projected to happen until next year at the earliest, but probably more like 2026 because they have a lot of CapEx left because of the fiber. If they get an increase in revenue because of the space technology with AST Space Mobile, that'll be the gravy that really pushes AT&T higher at some point. But I think we might be talking years yet. And I don't subscribe to the concept of dead money, but I do subscribe to the concept of I can do better over there. I think that might be where we're at. I'm just trying to maximize my gains. These are stocks I could own again. I just don't own them now. Shooter's primary waves are pretty interesting. I want to take a look at Tesla because it's a popular stock. And Tesla is in a wave pattern that should drive it well over $300 a share. But I have a hard time owning Tesla because it's not worth over $300 a share. And there's a lot of gaps that haven't been filled on their chart. So I think the next time that Elon Musk gets extra weird or they miss an order or something happens in China or whatever, the Germans tell them forget about it, I think the stock starts filling these gaps. I would buy Tesla in the middle 100s, 150-ish, 50-day moving average, and then all the gaps are filled. I have a hard time playing with it up here. It's very risky, and I would have to be a really good trader to do it. While I trust Shooter, I play with other people's money. I play with my own money. And if I'm not going to do it with my own money, I'm not going to do it with theirs. So I'm staying away from Tesla, and I bring this up because people ask me. It's just a hard stock to deal with when it's doing this sort of thing here. If it filled all these gaps, got into the 150s, or even retested the bottom but held, so 150s to 120s, that's where I would buy Tesla. Because then it represents some value on top of their long-term growth. You're getting a margin of safety because the price is lower, not higher. And then at that point, maybe it doesn't matter how weird Elon Musk is. Somebody posted the Teladoc and Spire Global that they bought, that their annualized return since they bought it is 1,500%. Well, it would be swell if that held up. My guess is that it won't. All right. Any questions before I call it a day? Make sure you read the plug and play stocks. There's going to be an update. I have to add Teladoc. Nothing. You're going to let me go? All right. I've got the Global Trends ETF coming out. That also has a new format. Again, geared towards actionable moves. I think that's what you all want. So that's the way I'm writing these now. Somebody asked about Paramount and Warner Brothers. Streaming seems to be in trouble. Man, streaming's been in trouble for 2 years. So that's not new. But the fact that you brought it up tells me that probably the final panics are happening. Warner Brothers and Paramount and the teens are screaming bargains based on the value of their assets. At some point, there will be more rumors about them getting bought out or merging with somebody or something. But the absolute value of their libraries, net of debt, are higher than the current share prices. And then, by the way, they have studios and future business that really don't get valued. And the studios are actually worth quite a bit. There was a shortage a while back, and I think that that's dissipated. But studios are not easy to create. There's one going in Georgia. But I think what you're going to see with this writer's strike and the way that Warner Brothers and Paramount and everybody else is starting to write their material is they're consolidating content. And there's no doubt that for a little while, and I talked about this for a couple of years, there was just too much content. You couldn't possibly watch everything that's out there, even if you limited it to the 20% best stuff. So I think that you're going to see Paramount and Warner both get into some sort of M&A, and I think they both come screaming out of it. I mean, maybe they just get bought, in which case we take what we get, right? I think Comcast is probably the best long-term play, but I don't think that they have much appreciation until after the M&A starts to happen, and I don't know when that's going to be. For younger investors, growth investors, I don't know that you really need TLT unless you're sitting on cash, and it can be a substitute for cash. So it's between 5 and 10% of portfolios for me. And again, if you're not writing cash secured puts, you could put that cash thing, the cash amount, in mostly in the TLT if you wanted to. Just understand that it's a trade. And when interest rates get down to 3-ish, probably we sell TLT. Hopefully that coincides with stocks being cheap. All right. Have a good day. I have so many articles to finish writing, and I am trying to write them in a way that's a little bit more actionable, and I will separate out all the thesis-based stuff and all the updates. All right. Have a great day.